What's up everyone, it's Karthik with MoneyVest. So I wanted to put together another spreadsheet which tracks the first cut from the Federal Reserve and the timing to getting into a recession in the US, because there is so much chatter around a recession over in the US. So I figured I'd do a very detailed video going over historical rate cuts and rate increases, and also how long did it take us to actually fall into a recession, because the SAM rule has been triggered. The inversion of the yield curve has been one of the longest ones we have witnessed of well over 750 days. So I really wanted to understand that if we were to actually fall into a recession, are we going to see any type of relief from the Federal Reserve in terms of rate cuts, which ideally we should, but this is a unique situation because inflation is still above the Fed's target. And if we were to fall, how long can we expect for that to happen? So this right here is a very quick note from short-term rates now fully pricing in a recession. So soft landing threshold was at negative 0.5. We are now negative 1% or lower. This is a recession threshold based on 6 months forward Fed funds pricing. And as I'm sure you can see, a lot of memes, and this week has been incredibly volatile in the market's expectations and understanding of a recession. So this was actually really funny from Ben Carlson on Twitter that I wanted to break down. The economy this week. Monday, the recession is on. Tuesday, recession canceled. Wednesday, no recession in the morning, but back on in the afternoon. And Thursday, the recession is canceled again until tomorrow or Monday. So that's really been the entire week. I mean, there's been a lot of data that's come out over the last week and a half. We've got the unemployment data. Of course, that's how it all started, sparking some concerns for a recession. Jobless claims coming in a little bit softer than expectations, signaling that there is not a recession. Then the SAM rule coming online, essentially suggesting for a recession. Then inversion of the yield curve suggesting that recession's off the table. So there's been a lot of back and forth from the market, whether there's going to be a recession or not. And these are some of the memes that I really wanted to bring up for all of you. So your son basically walks into the door. Are you winning, Dad? And the father goes, son, pack up your stuff. Just lost the house, and the entire heat map of just red across the board. Now, we did see a little bit of a relief rally on Thursday. So of course, we talked about it during our market update. And there are some other indicators, if you were to look at those, officially in a recession. And this is a Porsche driver delivering Domino's pizza. So even some of the wealthiest people here struggling, suggesting for a potential recession. But there are some really important indicators that I wanted to break down in this video, including my entire spreadsheet that we are going to talk about in this video. This is going to be super detailed. All I'm asking in return from you is that you drop a like. Let's see if we can at least get up to over 500 likes on this video, and also share this video with one person, friend, family member, trader, investor, somebody that you know of can benefit from this information and can find value in this. Please make sure to share this with another person. I would really appreciate that. Helps the channel grow very much, and it's really just recommendations like these that help us grow our community at MoneyVest. So what I have over here is essentially going back as far as 1954. So we're going back almost 60, 70 years to try to understand the Federal Reserve's hiking cycle, rate cutting cycle, how much did the rates increase during that cycle, and whether we fall into a recession or not. And if so, how long did it take for us to fall into a recession after the first rate cut? I want to be very clear. This is trying to understand whether we fell into a recession in the US after the first rate cut took place. Okay, maybe we were already in a recession when the Federal Reserve was cutting. Maybe we fell into a recession after the Federal Reserve cut rates. So that's accounting for both scenarios. And I hate to break it to you, the probability for us to have a soft landing versus a hard landing is not great. So this right here is a probability for a hard landing, and this right here is a probability for a soft landing. This is essentially suggesting for whether the Federal Reserve can navigate the economy, and the rate cuts accompanied with a recession is 75%. A rate cut not accompanied with a recession is 25%. So the probabilities are quite skewed, unfortunately, for us to see a recession in the US with a rate cut at over 75%. So there are certainly probabilities very high for us to see a bit of a hard landing in the US, even if it's a mild recession, even if it's a short-lived recession, the probability is quite high at over 75% for us to see a hard landing. And this is essentially accounting for simple data, simple analysis. What I've done here is that I've essentially looked at every time the first cut, right? So the Federal Reserve cutting interest rates going back as far as 1957, and whether that was followed with a recession in the US or not. And you'll notice that these are the red zones where every time the rate cut was indeed accompanied with a recession, the green is no. And out of the 12 instances of rate hiking cycle going back as far as 1950s, we have fell into a recession after the first rate cut 9 out of 12 times. So this right here is the breakdown. So you'll notice the recession happened 9 times. Soft landing happened 3 times. The total instances or observations here are 12. This is not accounting for the current rate hiking cycle that we're in. So you've got the question marks here because we're still yet to see whether we get a rate cut in September, whether that's followed with a recession, and if so, how long it's going to take us to fall into a recession after the rate cut. So that is still under question mark. But total observations, 12 instances, 9 times we fell into a recession after the rate cut, and that is a 75% probability for a hard landing versus a 25% probability for a soft landing. One more thing I want to mention is that the most cuts we have experienced from the Federal Reserve has come in the third quarter. We are currently in the third quarter right now. So July, August, September is Q3. October, November, December is Q4. And the most occurring cuts in the month of August. So the most cuts we have witnessed from the Federal Reserve in the past, going back as far as 1957, have happened in the month of August. And the cut quarter is also Q3, the quarter that we're currently in. And of course, there's huge anticipation for the Federal Reserve to cut interest rates in September. September is still going to fall within Q3 because that's what we have seen in the past. And that's really where we are at the moment. So 75% probability for a hard landing, 25% for a soft landing right now. So if you come back to this analysis, what you'll notice is essentially an understanding of also after the rate cut, how long did it take us to actually fall into a recession? Were we already in a recession or did we fall into a recession after? And this is going to be the remarks over here. So for example, 1957, we essentially witnessed the Federal Reserve cutting interest rates in November of 1957. That was after we were already in a recession, that we had dropped down into a recession in August 1957. So the Federal Reserve looks like they were still increasing interest rates. So the last rate hike was in October of 1957 when we were already in a recession by August of 1957. So they actually started cutting interest rates in November as soon as they found out that we were in a recession. So again, they were late to the party. And you'll notice that we had a recession first and a cut later. Same thing happened in 1960s. We had a recession first and a cut later. And that's a lag of about 92 to 30 days respectively. So what we really witnessed was 92 days it took the Federal Reserve to realize that we were in a recession before they started cutting interest rates. In 1960, that was the lag of 30 days. In December 1969, that was a lag of 90 days. The longest lag we have seen is November of 1973, that we had a recession first, 273 days before the Federal Reserve finally decided to cut interest rates. That is quite insane, right? 273, almost a year it took the Federal Reserve to actually start cutting interest rates after we fell into a recession. November 1973, 31 days, and that was on the opposite side. So we actually had a cut first, and then a month later, we fell into a recession in 1973. 1980s, a pre-lag of 90 days. So in other words, recession came in 3 months prior to the first Federal Reserve's cut. And then if you take a look at July of 1981, you'll notice a lag of 31 days. So recession first, and then a month later, the Federal Reserve started to cut interest rates. The longest recession to cut lag on the positive side is what we have witnessed is in July of 1990. So that's over a year of course, Federal Reserve cutting interest rates. And then after over a year, we saw a recession in the U.S. economy. And in fact, the last 3 times, the Federal Reserve has actually been has done a good job in anticipating a recession. They've cut first, and then a recession's followed later by an average of about 132 days. So if we do expect a September cut that is coming next month, let's say the Federal Reserve is going to cut interest rates. And right now, as it stands, some people would argue that we are in a recession, while some people would argue that we're not in a recession. So depending on which camp you belong to, you can get a good idea of how long it's going to take us for us to officially have a recession and have a bit of a hard landing in the US. So if I simply look at all these positive numbers and I try to account for the average, we come out to 164 days. So that's 164 days. It's going to take us to fall into a recession after the Federal Reserve's first interest rate cut that is expected in September. So 164 days is going to be about just about, let's see, this divided by 30, we're looking at just under 6 months. So September, and if you add on 6 months from that, so we're looking at sometime in the middle of next year in 2025, based on historical analysis for the U.S. economy to fall into a recession. And that's probably one of the reasons why 2024, there's not a lot of expectations from CEOs to actually expect a recession in 2024. So, this is the references to an economic downturn or a recession in earnings calls, which has hit its lowest level since 2021. As you can see, the overall trend is trending downward. So there's less and less CEOs expecting a recession in 2024. But this, of course, doesn't account for 2025 because that's still some ways away. So based on this analysis, we try to understand that, okay, after the first rate cut in September, it's going to take on average 164 days for the U.S. economy to fall into a recession, which is just under 6 months. And that can put us somewhere around, let's see, October, November, December, January, February, March. So March or April of 2025, that's going to be the ending of first quarter, beginning of second quarter into 2025. But the probability is quite high for us to see a hard landing of 75%. So hopefully this was helpful in your understanding. And again, the Federal Reserve, if you take a look at how many times they've been able to anticipate a recession prior to it happening, and they've cut sooner. So if you take a look, that's 12 instances. 6 times we have essentially cut interest rates before recession started, and 6 times we have cut interest rates after a recession started. And when we have cut interest rates after a recession started, we have done that on average by negative 101 days. So negative 101 days. So the Federal Reserve's been off by a little bit over 3 months in cutting interest rates after a recession started. So that, again, is going to be about 3.3 months. They've been late by over 3 months in some instances when they have cut interest rates after a recession had already started. But when they have anticipated a recession early, they've done it by just over 164 days. So they've done it a little bit too early by just over 5.5, just under 6 months when they have actually started cutting interest rates. And more recently, though, if you take a look at the last 4 instances, they've actually cut first and a recession's followed later. In the past, I feel the Federal Reserve was a little bit all over the place. So recession happened first and they actually cut interest rates later. But more recently, the Federal Reserve has been more cautious, more alert, and more anticipating of a recession. And they've cut early when a recession actually started. So I think that's one of the reasons why there's been a lot of chatter and a lot of pressure on Jerome Powell and the FOMC to actually start cutting interest rates because many people anticipate a recession is going to happen and it's going to follow if they don't. And that's why a September rate cut, the probability is so high for the U.S. So hopefully this was helpful. And one more thing that I want to mention, last thing that I'll say in this video is that if the hard landing probability is 75%, if you come over to how the markets perform during recessions, you'll notice that this right here is another really interesting data that we have shared in our previous videos, where you'll notice that if the bear market is accompanied with a recession, the bear market does last over 16 to 17 months with an average and median drawdown of over 30%. So things can eventually get worse if there is a recession. They're longer lasting. So bear markets are longer lasting and more severe. And if it's not accompanied with a recession, so if there's a soft landing for which there's only a 25% probability, yes, it's shorter lived. So the bear market can quickly recover and within 6 to 7 months. And the drawdown is also really small of just over 20 to 23%. So those are some things to consider. And let me know in the comment section down below, are you expecting a recession in the US in the next 6 to 12 months? And if so, how long you think it's going to be? And how severe you think the market's decline is going to be. But either way, that's only going to represent good buying opportunities for us as we are long-term investors and we can take advantage of this opportunity. So hope you all enjoyed this video and found it helpful. Make sure you drop a like and subscribe to the channel if you're just joining us for the first time. Link's going to be down below if you're interested in joining us. And as always, happy investing. I'll see you all in the next video.